Now, when you're watching this video, there's a good chance you've watched prior videos on this channel before. And you know that I try to squeeze out a little bit of extra performance out of any investment. Now, for crypto investments, that's comparatively easy because the market is still very immature. Not a lot of price efficiency happens there. However, the stock market has been around for a bit longer. In this video, we're going to talk about the stock market and how profitable strategies suddenly, after decades of working very well, suddenly stopped working. There are many interesting learnings from that. The TLDR is that as markets mature, it becomes harder and harder to beat just buying and holding. Now, I'm not going to repeat the fundamental approach of market timing here. There's a good chance you've already seen a chart like this. This shows on the x-axis the moving average duration. It shows on the y-axis the annualized performance. The dotted line, that's the historical S&P 500 return. And so this chart shows that it's very hard to outperform the S&P 500 just by following the trend. No matter what moving average we take, we tend to underperform if we sometimes just sell because we think we're now in a bear market. There is one exception though, the 7-day simple moving average. There's a lot to unpack with that exception. So the idea is straightforward. We buy when the price is above the moving average. We sell, so we are in cash when the price is below the moving average. We just capture the trend in the S&P 500 and we would have sold on the 27th of February. And we would have spared ourselves from a 3.5% decline. Now, doesn't that look good? The answer is, if you look at this over the long term, this approach is actually not that good. It used to be great, but it's not anymore. So have a look at the results here. At the top, we see the performance following that strategy. So that's just in US dollars. At the bottom, we see the S&P 500. This is a very, very long-term chart. It starts in 1871. But I want to look at the entire data set just to have an idea how those trading methods develop over time. Now, at the bottom, we see our performance of the portfolio relative to the S&P 500. And the strategy worked phenomenally well up until the 1990s. This year was the Great Depression. This year was the dot-com crash. This was the global financial crisis. And interestingly enough, the approach worked extremely well for 80 years to then suddenly stop working. In the past, it paid off to follow the trend and sell very quickly as momentum turns around, as we might enter a bear market. But in the last 30 to 40 years, this suddenly turned around. In the last 30 to 40 years, people tended to buy the dips pretty consistently. When the price went down, people rather bought more. Isn't it fascinating how there was this structural shift and how a strategy that worked very well for such a long time suddenly stopped working? Now, there are many ways to explain this, and I don't have the perfect explanation. I'm simply just showing the data, but we could explain this, for example, with technological advancement. Now we could crunch the data, and suddenly we had quants that could actually exploit market inefficiencies. It also, at the time, became much more commonplace to buy regularly into the stock market with 401ks, for example. So there were some structural shifts, and that might explain why it wasn't that profitable anymore to sell early when momentum turned around. But instead of having one moving average, we might use two moving averages to take away some of those failed signals, right? If we take a single moving average, we might be able to capture some of the momentum, but we also might get some failed signals. If we've got two moving averages, so one that's shorter in duration, and that might then also get closer to the price. Maybe at that point, we can get rid of some of the noise when the price just fluctuates around the moving average, and we can just buy when the short-term moving average crosses the long-term moving average, and we sell when we go below. So a strategy that creates less buying and selling signals, but that tends to work better for crypto. So maybe this could also work better for the stock market. So here's a backtest of all the moving averages from the 5-day all the way to the 365-day. We can see that the shorter term moving averages don't really work. It seems like between the 200 and 250-day moving average, we do have our optimum. So let's zoom in, then we get this result. And here we've got the best moving average combination. 204-day as the slow moving average and 225-day as the fast moving average. How much does this outperform? The answer is, unfortunately, not that much. We get 12.5% annualized return versus 11.2%. Yes, the Sharpe ratio is much higher, as is the Sortino ratio, because our maximum drawdown is lower. So we get more return at less risk, but we don't necessarily get more return. The longest drawdown duration from the all-time high to the recovery was 2,100 days for the strategy. It was 6,200 days for buying and holding. So there is less risk, there is less volatility, there is a lower beta. And the best year was much better and the worst year wasn't as bad. But still, overall, we do not get much more return. So this is the strategy, right? We've got those two moving averages. We want to be long when the shorter term moving average, the orange one, is at the top. We want to be short when the orange moving average is at the bottom. And so here's how that approach performed over time. We made a lot of outperformance during the Great Depression because we sold early. But outside of those extreme events, the strategy tends to perform worse because every now and then we are just in cash and we are not making any money. And so no matter how we slice and dice it, right? If we use one moving average or if we use a combination of two moving averages, really the market got too efficient. The stock market is extremely hard to time. When there is a crash in the market, people simply buy that crash. It could be direct purchases. It could also be policy, right? As prices go down, maybe the Federal Reserve has an incentive to loosen monetary policy to then create more money. And when there's more money, asset prices go up again. So whenever we crash, there are several forces that push prices up again. So every dip gets bought. And apparently that had not been the case for the first 80 years of the stock market's existence. But things have changed, and so now everybody just sets and forgets. Really, I find this extremely fascinating. Imagine you put in so much effort to crunch the numbers, to find a strategy that consistently outperformed for such a long time, to just see how this suddenly flips around, how the market matured so much that an approach to time the exposure suddenly stops working. This chart shows a clear story. It shows that when prices go down, it makes no sense at all to sell anymore. It rather makes sense to try to find buying opportunities. And so really, when our target is to outperform the market, it makes sense to do this with markets that aren't yet as mature. And the crypto market, of course, is not yet that mature. It's not yet widespread in 401ks, and the Federal Reserve is probably not going to change its policies just because Bitcoin is down. So there is still a way to make money with falling prices in crypto and to reduce risk exposure. Timing the market in crypto is smart. Timing the market in the S&P 500 isn't. It's better just to buy more and be reactive to price declines. When prices go down, it's better to contribute more to the asset class. So our dollar cost averaging could potentially become dynamic. We buy more as we have fallen more from the all-time high. So that's a plan for a future backtest for a video on this channel. I want to figure out how much do we outperform if we buy more when we've crashed more from the all-time high. How flexible can we be? How much can we outperform? And what's the best trading rule around that? If you got some value out of this video, feel free to give it a like. Feel free to also subscribe for that upcoming backtest. I will publish several backtests on this channel regularly. Looking very much forward to your feedback below this video in the comments. Feel free to also check out the premium membership. This is where you get access to the tool. The tool gets updated regularly, so there will be even more functionality in the future. See you next time. Cheers.